those were go-go days. Appreciation was going, so I would hold them about a year and a half.
Mm-hmm.
I think I refinanced that second group of duplexes and pulled out a couple of $100,000 and then used that as equity to buy something else and something else and something else, and kept doing that. So that's how the no money down things. Now, I want to go on the right. I don't recommend that. It is I don't recommend it without reserves. I mean, whether you're an investor or not, you should have reserves, for contingencies, because you never know what's going to happen.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba, a commercial real estate investor. And today I have a very special guest, Stewart Heath, with me. Welcome to the Real Estate Vibe Show, Stewart.
Thank you for having me, Vicky. It's quite an honor to be here.
Stewart is a founder and CEO of Howard Grace Capital, a private equity real estate investment firm that helps people build wealth faster through hands-off real estate investing that generates passive income, reduce risk, and maximize tax efficiencies. Stewart is a certified public accountant, a CPA, and has over 35 years of experience in real estate sector. His expertise encompasses multifamily and commercial property development, construction management, and investing. In 2008, he lost everything during the financial crisis, but learned a lot from the experience about the best practices for holding and managing real estate. And that's what we're going to be talking about today. So today's topic is rebuilding through business intelligence, lessons learned after losing everything in 2008 recession. So before we get started, Stewart, I would like to ask you if you can briefly share, how did you get here, or what made you who you are today?
That's a tough one, or a big question rather. I'm here through all of my life experiences. I had great parents. I'm a person of faith, and so my faith makes me a lot of who I am. My wife makes me a better man, and my children, my love for my children makes me want to be a better person for them. So I am who I am because of the culmination of all of the life experiences that I've had, including the one you just referenced, losing everything in 2008. So.
Wow, I love that. I know that's what it is. Our life is all about experiences and how you learn and how you progress and how you learn to live better life, right? Every time. So I'm going to ask you, can you again share your personal experience of losing everything in 2008 recession?
Sure.
How did that impact, your overall personality?
That's an interesting question. So I talk about this a lot. I've never been asked how it impacts my personality, but but it definitely has.
It does, though.
Yeah. Oh, no doubt. So, as you mentioned, I'm a CPA. I had my own practice coming out of the 1990s, and I had watched for years various clients, not get rich quick, but get rich, generate a lot of wealth, flipping houses, owning investment properties, cash flow, and in a lot of ways that I would sort of turn my nose up at. Well, I don't want to rent. I don't want to manage some crummy rental house. I mean, that's just. Just almost felt like it was beneath me. So in other words, I was rather arrogant. But at some point in the year 2000, I was in the middle of my tax season, and I was exhausted. I was working, 15, 20 hours a day, and realizing that while I was billing a lot of money that month, I was still making a nice income, but I wasn't building any wealth. So, uh, began to focus in on these clients that I had observed. And so I decided to start investing in real estate, theoretically passively, but it became anything but. And so I bought my first duplex in what was the hood of our town, Franklin, Tennessee. And it was a duplex. It had two tenants. I found that I liked talking to the tenants. I liked doing little odd jobs when they had needs. And so I kept looking for more properties, and about 8 or 9 months later, found a portfolio of 9 duplexes, all next to each other, up north of Nashville, Tennessee, and acquired those. And I kept going like that. So that would have been 2001 by the time I acquired those, and just kept buying and kept buying. All of this I'm being done. I was doing it with essentially no equity, no cash down. I had acquired one of those TV infomercial courses on how to buy real estate. Nobody did. Well, guess what, folks? That stuff works. You'd be surprised what a seller's response might be when you ask them a question. Don't predetermine their answer. Don't bias their answer, without asking them. And I kept building, and along the way, I partnered up with a guy and started building some houses. And then I bought a portfolio of condos and ultimately acquired every unit in that condo complex. And we began to rehab those, because condos and townhomes were massively popular during that time. And I saw great big companies who were selling 50, 60 units in a weekend. And it's, well, great. I'll flip this place and generate cash, and then just pay off my other properties, and then just move forward on a cash basis from there. So I was doing what's called equity stepping or equity flipping. I'd buy one property, hold it for about a year, refinance it, take cash out, buy something else, do that. To the point where 2007 comes, and there were warning signs in 2007. 2008 gets here. It's an election year, and the market had definitely slowed down. I was in the middle of trying to sell all of these condos that we had rehabbed. So I had taken a cash flowing property, taken them offline to rehab them, and then couldn't rent them. And so 2008 is when the real crash happened. So June 30th of 2008, I produced a personal financial statement for the bank, and all based on appraisals, no funny business, anything like that. Had $25 million in gross assets, a net worth of $15 million, and almost no cash. Certainly not cash that you should have when you're dealing with those kind of numbers. So 90 days later, this was after Countrywide Mortgage had failed. There was an official financial crisis in the mix. Election year, John McCain has suggested to Barack Obama that they should go back to Washington and help fix the crisis. So 90 days later, I like to say that I was probably went from 15 million net worth to $5 million underwater, a $20 million swing in 90 days. And that's because nobody was lending any money at that point. And real estate is not worth a whole lot if nobody's going to, the reason it's so powerful is because it's a leverageable asset.
Mm-hmm.
And if nobody's lending, then your holdings aren't worth a whole lot. And there I was, the world had stopped, and I had no reserves whatsoever. I later calculated that if I had reserves of as little as 300,000 or even as much as 500,000, I could have survived that period for 9 months to a year, when the world started loosening up again. But I had nothing, and it spent the next year giving most of those properties back to banks, and ultimately filed bankruptcy about a year later. So that's my story. Had a lot of fun building that portfolio. Wasn't so much fun going through the unwinding of it, and money comes and money goes. It's the personal costs that go with that. That impacted everybody around me, so that wasn't all that funny. So you asked me, how did my personality change?
Mm-hmm.
Well, I got a lot less arrogant.
I know. I'm going to ask you that question later, but this story has so many golden nuggets, and then I'm going to ask you so many questions here, super crazy. You started with one duplex in 2001. And how many did you have by 2008, early 2008 or late 2007? Before
I had over 200 residential rental units. So that included houses, duplexes, and stuff. Along the way, I had acquired a property management company just so I could hire staff to manage my own stuff, and as well as office condos and homes under construction. So, yeah, it was kind of a mess. So.
But that was great journey, right? Like in 6 years, building that big portfolio. And then I think that was pretty awesome. You said 25 million or 50 million, right?
25 million.
$25 million portfolio in 6 years. Oh my God, that was, I think, quite an achievement if you look at it. And the other thing that you mentioned, Rod, you said you were getting all this no cash down. So if you can shed some light on that. How did you do that? Because that is applicable in today's day too. People can still do that.
Yeah, and I say this with a caveat. Now, back in the day, there was this guy who used to have infomercials on TV at night, Carlton Sheets, and he had a program called No Money Down. I still have it. It was about 12 tapes and a bunch of in a 5-inch notebook, and there's been a lot of people along the way, but this guy was. I just have to say, it was pretty good stuff. I mean, I'm a CPA. I know a thing or two about business, but this was pretty good common sense stuff. And so I followed a lot of his steps. And so, as in most things in business, you're gonna turn over a lot of rocks, or like I like to say, kiss a lot of frogs before you find one that becomes a deal. You can ask a lot of sellers, would you be willing to finance this for me? And 9 out of 10 of them are going to say no, but gee whiz, if you can do a deal on every 10th property that you come across, you're going to end up with a lot of stuff. So I got started doing that. The first duplex I got was seller financing. I put down $5,000 and he financed $50,000, so I bought it for $55,000, and I had to refinance him out in like 3 years or something like that. I forget. That second group of duplexes, I was able to get bank financing for 70%, and I got the seller basically to take back the rest, and I put very little money in that. I had to cover some closing costs and whatnot. And so that kind of got me started with the equity stepping thing. So that second deal was about $1 million, 14 duplexes. So those were go-go days. Appreciation was going, so I would hold them about a year and a half. I think I refinanced that second group of duplexes and pulled out a couple of $100,000, and then used that as equity to buy something else and something else and something else, and kept doing that. So that's how the no money down things. Now, I want to go on the right. I don't recommend that. It is I don't recommend it without reserves. I mean, whether you're an investor or not, you should have reserves, for contingencies, because you never know what's going to happen. But yeah, I was pretty well convinced, this merry-go-round was never going to end, and so and I had a plan to cash out those condos and pay off all the debt on all my properties, and then just manage a portfolio debt-free. But the ride ended before we could sell all those condos. So.
Yeah, I know. You said if you had $300,000 to $500,000, you could have survived another 6 to 9 months,
Yeah.
and that could have saved you going into bankruptcy. And the thing is, you mentioned that you're taking the equity out, putting in another deal, then taking that equity out, putting another. That's kind of a little bit over leverage, I would say. Not a little bit, a whole lot over leverage.
Oh, it was completely over leveraged. So yeah,
like way too much over leverage, without having your own pockets like a little bit deeper, in case something happened, because you were on this upward trend. So looking at, that journey or that particular experience, because I know a bunch of my friends, they did the same thing too. They were just over leveraged, and then everything was gone. Because in 2008 push, everything was like a clean slate, starting all over again. And I've seen that happening to multiple people. But before that, the mindset was always like that, I'm on that trajectory of growth, I'm the almighty. Now what's going to happen, because I can foresee the future. So I'm pretty sure that have changed you a lot. But looking through all those experiences, can you share, what is your going forward strategies now?
So yeah, I went back, got a job for several years. I've been a CFO for multiple companies, and sort of returned to my consulting roots. But the love of real estate never really left me. I like to say that Wall Street likes to call it an alternative investment, and I call it, well, actually, it's the original investment.
I like that.
And it's just, I don't want to call it simple, but it's just so investable. It's just so investable, unlike, which, I'm not against stocks. I own some stocks, but I mean, that's, to me, most of that's far riskier than owning a hard asset. So what I've learned is learn some discipline. I've learned the critical importance of recurring cash flow. And so that's kind of what I counsel people. And I say, I hope that their financial planners are telling them the same thing, that recurring cash flow, be it a dividend paying stock portfolio or rental properties, but recurring cash flow that is not very much impacted by the ups and downs of the market, is the foundation to everyone's investment portfolio. And once you have that, then sure, go buy some Bitcoin or go buy some IPO stocks, or go try a real estate development or something like that. And go try something, add a little bit of risk in there, because more risk generally brings more reward, but sometimes it just brings more risk. And so build that foundation of recurring cash flow, which you can get pretty easily from real estate. And I'm not a proponent that real estate's the only investment, but recurring cash flow, that's what real estate is all about, essentially. And so ask yourself, 90% of the family offices, and I get this from the Family Office Club, have a foundation of real estate at the core of their investment portfolio. A lot of them are active in other type of venture funds, but they're doing that from a platform of, hey, the overhead's covered, because no matter what they do, the cash will keep coming in from that core investment. So that's what I've sort of become the evangelist of, as well as very conservative underwriting and building reserves into every transaction that we do.
That's true. That's a good tip right here, but having the reserves all the time and do not over leverage. But beside that, what other lessons were learned from this whole experience?
Mainly the business lessons, not over leveraging. And we're going to close a deal later this month, and I've got the banker trying to push me up from 60% LTV to 75. And it's like, it feels a little bit like '08 all over again, where the bankers were so willing to loan money. And so I've got discipline, and I'm saying no to that. Gee whiz, I could have a lot less equity in the deal if I did that. So personal discipline, a lot more patience. I don't feel the need to do every deal that I come across, even though I can. We've walked away from 2 deals this year already. There'll probably be more, and so discipline and patience, I would say, would be the main personalities.
Okay, so let me ask you this question.
Yeah.
So this experience of losing everything, how did it shape your, because your risk appetite might have been changed because it's like, I don't know, it's like a totally paradigm shift for you, losing everything.
Oh, yeah.
All of a sudden, you're like sitting up there, and all of a sudden you feel like, oh my God, nothing is there. There is nothing to look for in future. Kind of it changes you. I think it alters your mental status too.
Sure. It's made me only want to look at stabilized deals. Now, that said, we have one that we're looking at an expansion on. We don't have to do it, but we likely will because we're 100% occupied. And so when you start looking at value adds or expansion, those are technically development deals, but they come with a different risk profile than ground up development. But when I go to market looking for the next thing, I'm looking for stabilized cash flow deals, what I like to call boring stuff. These are like the dividend paying stocks that you never hear about on TV, on CNBC or anything like that. So, but they're just mature. Now there's money to be made there, because a lot of times you find these things and they're cash flowing, but they haven't been managed well. And so you can make money through the management of an asset that doesn't necessarily have to be very risky. You might risk, or you might choose to push out one tenant who won't accept a rent increase. If they're $10 below market, why would they? But you're confident about your asset and that it will ultimately bring a tenant at the market price. So, and that's management. So, from a business perspective, I've gotten a lot more confident in looking how you maximize the value of an asset through management. Not saying we won't do development deals in the future. Obviously, those are great opportunities. But the current time, we're preaching to all of our investors recurring cash flow, recurring and increasing cash flow, fixed rate interest.
Okay, so you're just like more careful now after that experience,
absolutely.
right?
Absolutely.
So you said you're more disciplined, you're more confident because you are looking at the numbers differently. You wanted to make sure 100% of the numbers are making sense in the underwriting before getting onto any deal. And then you're saying you don't want it to take too much risk either. You want it to get more into cash flowing properties where you're making cash day one, because you would just say that your risk tolerance has changed. It's like has shrunk a little bit.
Oh, sure. Yeah. I'm
Mm-hmm.
much less willing to take risk. And here's something else I've done. I keep a team of people around me who check, they check my work. I mean, back before I was doing all of this by myself, and truth be told, I was probably lying to myself in my own spreadsheets and just because I wanted to do another deal. And so I have people who keep me accountable and make me they make me better businessman by saying, yeah, I don't think you're going to get $24 a foot there. I think it's more like 22. And that's within reason, but $2 a foot can make the difference in a purchase price.
That's true. It does.
And so I have people around me that challenge and push me, and vice versa, so that hopefully the risks of just going out and doing a stupid deal for the sake of doing a stupid deal are gone. So.
Oh, I like that. So all the deals that you did, 200 plus, that you had before during the 2008 timeframe, you did it by yourself, or did you do syndication?
No, I didn't do any syndications.
No syndication, all by yourself. And you learned a lesson from there. And then the other thing you mentioned very funny was just like lying in the spreadsheet and lying to yourself, And a lot of people do that, whether you're syndication, JV, by yourself, because you want to make the numbers look good because you like something, right? You like the deal, you want it to make the numbers good, and you can polish numbers as much as you want in the spreadsheet, and you can just make it look good, but you have to be true to yourself, like you said, So that's a really good thing. So other thing that you mentioned very early on was that there was some warning signs in 2007. So I wanted to understand that. What was those warning signs?
I believe it was either Lehman Brothers or Bear Stearns went under in Q1 of 2007, I want to say.
Mm-hmm.
And I'm relating that because I talked about the condos that I had acquired and that we renovated and we put them out on the market. Because in January of 2007, and this was sort of a confirmation to my strategy, I had acquired 72 condos. I bought the whole unit. It took me 3 years to do that. And then we started with the first building and renovated the whole thing. And so in January 2007, we had sort of a grand opening, and I had 26 done, ready to go. And I sold 28. So I sold everything I had and 2 pre-sales in 2007. About a month after that, I think it was Bear Stearns that started going south. And then you started hearing people more about layoffs and things of that nature. And what was fascinating to me, I'm just like, yes, this plan is working. See how smart I am. So I didn't sell another unit for a year. I didn't sell one more. I thought I was going to be 12 months ahead of plan. I thought I would have sold them all by May, and didn't sell another one. We did close on those 28, but only 2 more, but before I ended up having to give it back to the bank. And so warnings, interest rates were going up, if I recall correctly. Bear Stearns crashed and nobody came to the rescue. Layoffs were starting to come. Home builders were home sales were slowing down. And so those are the warning signs that I recall.
Okay, so I'm going to ask you another question here. So if we take that scenario, what happened in 2007? Those were the early warning signs. You said countrywide mortgage was down, right? And then interest rates were up. There was layoffs. Job market was not that great. So let's compare that scenario with today's market. So we are seeing banks failing in today's market as well. Interest rates are up and people are predicting recession. Some people are saying we're already in recession. A lot is going on. So you've been there, done that. So how would you compare the 2 market conditions? And what would you do in today's market? I know it's a long question. It's 2 phases. If you can share that.
Sure. Yeah. The short answer is I see nothing comparative about then and now, up until the last few months. Now, the bank failures are definitely concerning, but they're to be they're to be expected. They should have. I mean, you're going to raise interest rates 500 basis points, and yeah, it's not like Silicon Valley Bank was doing high risk mortgages or anything like that. They were holding treasuries. So I know they were doing venture loans and stuff like that. But these other banks, they've not been doing risky lending. They held treasuries, and I guess they were unwilling to take the hit publicly for the mark to market, and until it was just too late. What's different between then and now is the ability to move several $1 billion out of deposits of a bank in the matter of hours. That technology did not exist, 12 years ago, or however long ago it was. There were a lot more job losses back then than there are now. You hear about a few, but the employment market is very strong right now. I haven't quite figured out how we're going to have a recession when everybody who wants a job has a job.
That's
true. It's pretty hard to slow down economic activity when everybody's employed and can consume at will. Now, they've definitely had an impact of slowing it down, they being the Fed. You're going to slow down housing with higher interest rates. And I think we'll see that come back pretty quickly as people adjust to that market, as builders adjust and they build a different product. But in my opinion, there's not a lot. There's not a lot comparative. Now, I thought we had been in a recession when we had 2 quarters of negative GDP growth, last summer, I think. But I guess I'm old school. That used to be the definition, and apparently I'm uneducated, and I don't know what the definition of a recession is. I think the definition of a recession is once they know we're out of it, then they tell us we were in one, and then, oh well, we had one. Last fall to me felt like a recession, but it turns out it wasn't. We definitely had a slowdown. But what we're doing to get to that, is we're meeting with our investors. We're laying the foundations to raise a fund. I do believe more pain is coming. I do believe more bank failures are coming, which perhaps for the first time in my life we'll be in a position to take advantage of. So there's going to be great assets hitting the market that people can't afford to refinance for whatever reason. And so we'll either buy them from a bank or we'll buy them from somebody at a fire sale. So I think that's coming. I think it's going to begin in Q3 of this year and last for a year or 18 months. So we're trying to gather dry powder to be aggressively acquisitive, although they'll be stabilized cash flow properties.
That's true. I know, I agree on that. Comparing the 2008 and now, there's quite a bit difference. They're not exactly same situation, because every time we go through some kind of downfall or even, any kind of experience, we improve on that because we have learned some lessons there. And then when the next time it happens, we're not doing the same things. I know banks are still failing, things are happening, but the banks are being bought by the other banks. So I just feel like, it's kind of a law of nature too, we expand and we shrink, we expand. So that's the kind of things that are happening. So banks are just like collaborating, I would say, even they're acquiring the smaller banks at this point. So things might look different. And then you're still buying, you said, you're pretty aggressive. You're saying there's going to be so many deals in the market, so many good deals that you're going to get hands on. You are very optimistic about that. And me too. As I said, we are very optimistic about that. So there's going to be a lot of opportunity in this challenge, that we're going to see. So in your crystal ball, what do you see for the next 2 years? What's going to happen in the market?
I think that the people who are saying interest rates are going to start coming down later this year are wrong. I think they will start coming down Q2 of next year. I personally think the Fed is done raising interest rates,
Mm-hmm.
although for whatever reasons, they can't bring themselves to say that. I think so. I think the Fed is uncertain because they're not quite certain how to evaluate the gig economy. Matter of fact, the chairman said that not too long ago, that they're just now beginning to realize that there are so many more people self-employed since the pandemic. I'm like, duh. I mean, that's been apparent since the fall of 2020. But so going forward, yeah, and I'm hedging because I'm not so sure how in my chosen market of Huntsville and how many opportunities there are going to be, because it's such a strong market. But I do believe there'll be several properties come available for us to try to take advantage of. I think there'll be a lot of competition for that. Anyway, we will get our share, and it is our hope that we will be able to move quickly with dry powder, grab these properties quickly, and then wait for the opportune moment in the debt markets to then put financing on them, replenishing our capital, and go out and get some more. So that's what we're intending on doing. But and then so I think that's the next 2 years: falling interest rates and increased economic activity.
Things gonna change a little bit or shift a little bit. That's awesome. So we are out of time. I know we are over time. So it was a good conversation. So can you share quickly one golden nugget with my audience?
Always have reserves. You don't know what's going to happen.
I like that. That's so true. So this brings us to our why rapid fire round. So I'm going to ask you 5 questions. You're going to answer in 1 word, 1 sentence only. Yeah. So are you ready?
Yeah.
Okay. So I'm going to ask you the first question. What is one of the most important things that you have learned in your life? And how did your life change after learning it?
The importance of family and how important it is to preserve that. And my life is much richer once I accepted that real truth.
Share one good book that you have read and recommend to my audience.
Probably been said before, but Rich Dad, Poor Dad.
Beside that, everybody says that.
Traction.
That's a good one too. Yeah. Very common one as well. In one word, sure. What does life mean to you?
Fulfillment.
I like that. Because the life is totally different when you're coming from a place of fulfillment. And it seems like you are now, right? After the 2008 experience, because personality has changed completely, maybe. What is your biggest passion?
Honestly, business, real estate. I love what I do.
Like that. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Be patient. It's a long life. You don't have to achieve everything right now.
Good one. How can people reach out to you, Stewart?
Our website is harvardgracecapital.com. If you go there, you can see videos of me. But if you would navigate to the resources section, and we have a due diligence checklist for passive investors on how to check out your sponsor before you make an investment. So if you would, we'd love to have you on our mailing list, or you can just hit the scheduling link, and I would be happy to talk with anyone and everyone about real estate.
Thanks for being on my show, Stewart. I really enjoyed our conversation.